Hello and welcome to Smart Money. Now, on the occasion of Children's Day, we decided to move out of the office and head into the Edelweiss office to meet Radhika Gupta, the MD and CEO of Edelweiss Asset Management. She needs no introduction, of course, but she's a new mum, so she has a new job as well to handle. And Radhika, first of all, congratulations on the new role that you have assumed. It's a great time to talk about planning for your child, right? Because you are a mother now, and you know anything and everything about investments given your long trajectory and your career. But tell us a little bit about how you're feeling as you enter this new phase.
I'm feeling good. I would describe it as beautiful chaos. So it's chaos. I don't want to say that life is perfectly sorted between a CEO role and a mom's role and Amphi Vice Chairman and the 500 things I do. But it is beautiful. It's wonderful to walk home and have someone smile at you. It's fantastic. Beautiful chaos.
Like someone once told me, it is the most exhilarating and exhausting experience at the same time, motherhood, right?
It is exhilarating and it is exhausting, and it is both in the same day, sometimes in the same hour and in the same 2 minutes. But I wouldn't have it any other way, and I think I couldn't have thought of a better time to have a child than this. So I think it's worked out the right way.
And it's been a great journey for you, right? I mean, after such a long stint, a successful career, now you've embarked on motherhood. But it also brings us to the point about investments, because we tend to get so lost in this daily rigmarole that we forget about investing for our child. So let's talk a little bit about that. I mean, since it's Children's Day, when is the right time to start investing for your child?
I genuinely believe as early as possible. In fact, my husband and I were very clear that as soon as we had our son Remy, we would start the process of getting his Aadhaar and his PAN and all his docs in place, because that, of course, precedes investing. So we got all that done. He went to the Aadhaar card office, got his little cute picture taken and everything. And he's about to make his first investment actually next week, because he just got his bank account open. I think really the earlier the better, for two reasons. One, of course, we've all talked about compounding. So I think the power of compounding is immense for children, and the sooner you start, the better. Secondly, we all talk about influencing children and the importance of children learning financial literacy, the importance of how to manage your money, the importance of valuing money in the first place as they grow up in a more prosperous India. And I think what better way to teach them about managing money than them having their own investments in the first place.
And, you know, we did an episode last week on the occasion of Children's Day itself, where the expert was pointing out that nowadays children find it very hard to know the difference between want and need. When we were younger, things were very different. And now, as you said, a more prosperous India, you need to kind of instill those values. But when you talk about the power of compounding, right, there's so much that you can do for your child, so many options out there. Where do you start and how do you decide?
So I think you want to keep it simple with children. Children have a long time horizon, which means they have risk appetite and they need wealth creation. So equity is, of course, the right asset class, I think, for children. If you're looking at long-term investing, I mean, for my son, we're looking at 18 years, definitely, right? So equity is the right asset class. I think within equity, what we are going to do, and I think what works for most children, is index funds. They're simple. You're finally buying India's growth. It's a child growing up in a prosperous India who's going to benefit from the economic growth from India. So you want to look at equity index funds, which will give you that long-term India equity growth. You don't have to worry about which fund manager, what will happen over 18 years, because 18 years is a long, uncertain period. So index funds are a way to cut out that uncertainty and just give them the India growth.
Okay, so that's on the equity side, which I will come to in detail later. But what about other asset classes and what about other schemes, right? Whether it is, say, FDs or corporate FDs, Bharat Bond, you have the Sukanya Samriddhi scheme. How do you decide how much to put where?
Okay, so I think finally you have to do an asset allocation for your child, and asset allocation is very personal, whether it's for an older person or for children. If you want to add debt as a part of your asset allocation and you're doing long-term debt investments, then I think long-dated target maturity funds. For instance, you can do a 15-year target maturity funding. We have a 2037 fund. You can lock in rates today, and rates are high today, incidentally, when we're having this conversation, for a 15-year period and then realize that. So a long dated but tax efficient option I think could work nicely. The second asset class I think that works well beyond domestic equities is international equities for children. The reason is many of us will want our children to study abroad. Now, when I graduated from college from Wharton, fees were 40,000 US dollars, and I think the exchange rate was 40 or 50.
Wow.
Cut to today, the exchange rate is 80 and fees are probably $70,000. So you want some benefit of that dollar appreciation. So you can take money and park it in a foreign equity index fund or a foreign index fund, some part of it for college education.
Okay. So you said foreign equity fund for, college education, right? If you had to look a little more deeper into the Indian equity space, if you want to sort of start, now I have a 5-year-old and I want to start investing for him. How do you decide whether I need to get into large caps, mid cap, small cap funds? What should the kind of portfolio look like, the model portfolio?
So children, because they have risk appetite, I think some kind of multi-cap approach works to children. I'll tell you what we are doing, with our son. Now, we have an index fund called a large and mid-cap index fund. So it has 50% large cap exposure and 50% mid-cap exposure. A pure large cap portfolio, I think for children, in my view, is a little conservative. They want, they need the alpha of mid-caps. Now, you can debate small caps, etc., etc. But I think this 50-50 combination, which we have in a single fund, that's one that we're going to do. An SIP approach works well for children. So parents can start saving month on month, take a portion of their monthly savings and just allocate it to the child. And then they can top up the SIP as incomes rise, needs rise, etc. So I think a blend of large and mid cap or some kind of multi-cap approach works really well.
Okay, and within passive funds, what are the options that you would suggest? Say, for children, I will come to actively managing your portfolio next, but within passive funds itself, what's the approach?
So I think the passive equity fund range is very vast today. That is the good news.
And it's very confusing as well, right? For people who, for you and me who've tracked the markets for long, we know our way through. But every other parent I meet tells me that I'm so confused. I don't know where to put the money.
Seriously, because there are large cap things, there's small cap things, there's smart beta things. What do you do? So I think I'm going to name a couple of things I like. As I said, I love this large and mid-cap fund because it's just one simple option. And if I did nothing else for my kid and just did this, I'd be quite happy in a single fund because parents have a lot of parenting to do besides managing money for their children. Within equity index funds, there are also other options. So you can create your own combinations. You have mid-cap passive funds, you have small-cap passive funds, you have Nifty and Next 50. So you can take all of these and make your own combination of a multi-cap portfolio. So that's one very nice thing you can do. I think those are, and then you have a bunch of debt passives, as I said, that work really well.
So, if you're looking at long term, right? You said you're investing for your son for the next 18 years. Now, we live in a world where there's so much digital disruption every year.
Yeah.
How do you deal with that? A sector that is in flavor today is suddenly become redundant tomorrow. Do you just ride it out, or do you take stock of your portfolio every few years that you've invested in for your child and change your approach? How does it go?
I don't think you worry about that too much because 18 years is too long a period to predict, right? So I think you go with a diversified fund approach and you really go with the belief that if you're investing for 15 or 18 years, as long as you get the India growth story plus some alpha, as long as you get some combination of large, mid and small, and you get a cross section of sectors that works. One of the nice things about index funds is that indices are self-selecting. So if IT as a sector is growing, market cap of IT companies will grow and it will be a larger portion of the index. So you will get that growth, maybe with a lag, but you will get it in passive funds.
So do you have a historical, summarization of how perhaps the Edelweiss funds have done? In the last, say, 5 to 10 years, have the index funds beaten the benchmark? Have they beaten passive, active funds? What does the data suggest?
So I'll give you 2 data points. One is of a fund a combination that we're launching, and one is of a fund that exists today. We did a combination portfolio of 3 funds that are coming up for launch. Very, very simple funds. A Next 50 index fund, which all viewers are familiar with. A mid-cap momentum fund, so which is 50 mid-cap companies out of the mid-cap universe. And a small-cap index fund. these three in a combination, and you can pick the mix you want. You can pick 50-25-25, you can pick 40-30-30. On a risk basis, they're actually similar to actively managed funds. On a return basis, they outperform by a couple of percentage points. The other one so that's a nice combination that you can make, and you can tweak the things. You can tweak the choices. If you want to be more conservative, you add more Next 50. If you want to be more aggressive, you add more small cap and mid cap. The other one that we've done is for our large and mid cap index fund, which is the one I talked about. I think that beats most large and mid cap active funds quite handsomely.
Oh, really?
Yeah.
Okay, well, I do want to talk a little bit more about that, but I'm going to take a small commercial break. Be right back in a bit, in moments from now, back on Smart Money.